Ever wondered how your money could work harder for you? Have you heard about mutual funds but aren't sure what they are or how they work? Well, let's unravel the mystery. Mutual funds are essentially a professionally managed investment vehicle. This means a bunch of experts take your money, pool it with money from other investors, and then invest it on your behalf. Sounds simple, right? But the real magic lies in the potential benefits of this arrangement. You see, mutual funds offer a level of diversification that can be difficult for individual investors to achieve on their own. They spread the risk and reduce the impact of any single investment's performance on your overall portfolio. Plus, you get to take a back seat and let professional portfolio managers make the investment decisions. All of this makes mutual funds a popular choice for many investors. So, let's dive deeper and understand how mutual funds work step by step. The first step in the world of mutual funds is the pooling of investors. This is where the magic begins. As a multitude of investors come together, each bringing their own financial contribution to the table. These investors purchase shares or units of the fund, essentially buying into the collective investment vehicle that is the mutual fund. Now you might be wondering, how does ownership work in this scenario? Well, each investor owns a portion of the fund's assets. This ownership is proportional to the number of shares or units they have purchased. So the more you invest, the larger your slice of the pie becomes. It's an elegant system, really. It allows a diverse group of investors with varying financial capabilities to pool their resources together. This collective effort then forms a more substantial investment pool, enabling the fund to step into a wider range of investment opportunities. Now that we know who the investors are, let's move on to what they invest in. Diversification is a key feature of mutual funds. In the world of investing, diversification is like the safety net of a tightrope walker. It's there to catch you if you fall. Just as a tightrope walker wouldn't risk their life on a single thread, an investor shouldn't risk their hard-earned money on a single investment. Mutual funds typically invest in a diversified portfolio of securities. This could include a mix of stocks, bonds, and money market instruments. The aim is to spread the investments across different types of assets, sectors, and regions. You see, each type of investment comes with its own set of risks and rewards. By spreading your investments, you're essentially spreading the risks too. Let's consider a scenario where you invest all your money in a single stock. If that company performs poorly, your entire investment takes a hit. Now imagine you've invested in a mutual fund that holds 100 different stocks. If one company performs poorly, the impact on your overall portfolio is significantly reduced. This is the power of diversification. Diversification isn't just about reducing risk, though. It's also about potential returns. Different types of investments can perform well at different times. By diversifying, you're giving yourself the opportunity to benefit from various sectors and asset classes as they grow. Consider this. You're at a buffet with all your favorite foods. Would you fill your plate with just one dish? Probably not. You'd likely try a little bit of everything to make the most out of the experience. That's exactly what diversification does for your portfolio. It allows you to taste a bit of everything the market has to offer. But remember, diversification isn't a guarantee against loss. It's a strategy to manage risk and potential returns over time. It's about balancing the potential upsides with the potential downsides to achieve your investment goals. With diversification, you're not putting all your eggs in one basket, but what's the strategy behind choosing these baskets? Stay tuned as we delve deeper into how professional managers select the right investments for a mutual fund. This is where the professionals step in. They are the guardians of the mutual fund, the conductors of the financial orchestra that is your investment. These professionals are known as portfolio managers or investment management companies. They're the ones who take the reins and manage the pooled resources of the mutual fund. At their disposal is a team of financial analysts, statisticians, and market researchers. They pore over balance sheets, dissect financial news, and scrutinize market trends, all with the aim of making the most informed decisions on where to place investors' money. These professionals are responsible for selecting the investments that make up the mutual fund. It's their job to sift through the thousands of available securities, stocks, bonds, and other instruments, and pick the ones that fit the fund's strategy and objectives. This is no small task. It requires a deep understanding of the financial markets and the ability to predict future trends. Once they've selected the securities, the professionals don't just sit back and watch. They continually monitor the performance of the investments, ready to make buy or sell decisions as market conditions change. Their goal? To ensure the mutual fund is always aligned with its investment objectives and strategy. This active management is a key feature of mutual funds. It allows individual investors to benefit from the expertise and resources of seasoned professionals, something that would be out of reach for most people investing on their own. Well, now we know who manages these funds and how they do it. But what's their goal? Every mutual fund has a purpose. It's more than just a collection of stocks and bonds. It's a vehicle designed to drive towards specific investment objectives. The objectives can be as diverse as the investors themselves, varying widely based on the fund's focus. Let's take a walk down the mutual fund lane. You'll find some funds are like high-octane sports cars, aiming for capital appreciation. These are often growth funds, investing in stocks of companies that are expected to grow at an above-average rate compared to other stocks. The goal? To maximize capital gains, or in layman's terms, to buy low and sell high. Then there are the steady sedans, the income funds. They focus on regular income generation, investing predominantly in government and corporate bonds, or in stocks that pay dividends. These are for those who like a predictable, steady stream of income over a high-risk, high-return adventure. We also have balanced funds, the all-terrain vehicles, if you will. They aim for both growth and income by investing in a mix of stocks and bonds. They provide a balance of growth and income and are a good fit for those who like to keep things steady but aren't afraid of a little adventure. And lastly, we have the money market funds, the safe and sturdy family vans. They invest in highly liquid, short-term instruments and are considered low risk. These are for those who prioritize safety over high returns. So we've got our goals set, but what does it cost to achieve these goals? Like any service, mutual funds come with costs. These costs are required to cover the management of the fund, and they can be broken down into three main categories. First, we have management fees, which are paid to the portfolio managers who are making those all-important investment decisions on behalf of the fund. Next up are administrative expenses. These are the costs associated with the day-to-day operation of the fund. Think of things like record keeping, customer service, and legal services. Lastly, there are other operational costs, which can include anything from the cost of buying and selling securities to the costs of marketing the fund. Now, all these fees and expenses are typically expressed as an annual percentage of the fund's assets. This is known as the expense ratio. The lower the expense ratio, the less you'll pay in fees, and the more of your money will stay invested in the fund. With costs taken into account, let's see how we measure the value of a mutual fund. Ever wondered how much a mutual fund is worth? That's where the net asset value comes in. Now imagine a mutual fund's portfolio as a basket full of different securities, stocks, bonds, and the like. Every day, the total value of this basket is calculated based on the closing prices of each security. That's what we call the portfolio's value. But how do we know what each investor's share is worth? Here's where some division comes into play. The total portfolio value is divided by the number of outstanding shares in the fund. This gives us the net asset value, or NAV per share. Think of it as the price tag on each unit of the fund. So whether you're buying into the fund or selling your shares, this is the price you'll typically deal with. Now that we've got the value down, let's talk about getting your money out. Investing in mutual funds is not a one-way street. Let's talk about liquidity first. Mutual funds offer the ability to buy or sell shares on any business day at the current net asset value price. This ease of buying and selling gives investors the flexibility to manage their investments according to their needs. Now, let's move to redemption. When an investor decides to sell their shares, they are essentially redeeming them. The fund may need to sell securities from its portfolio to fulfill these redemption requests, ensuring that your money is always accessible when you need it. Lastly, we have distribution. Mutual funds often generate income and capital gains, which they typically distribute to investors. This might be in the form of dividends or capital gains distributions. It's important to note that these distributions are usually taxable to investors in taxable accounts. And that, folks, is how mutual funds work, providing flexibility, liquidity, and diversification to investors. So we've taken a journey through the world of mutual funds. We've delved into the pooling of investors, the benefits of diversification, and the expertise of professional management. We explored varying investment objectives, broke down the fees and expenses, and demystified the concept of net asset value. We also discussed the importance of liquidity and redemption. These elements all work together, making mutual funds a popular choice for many. Remember, understanding your investments is the first step towards financial independence. Happy investing!